infrastructure has moved from niche theme to the core of the investment narrative. But what we are seeing now feels like a transition into phase two. Markets are no longer just rewarding the build-out itself, they're starting to differentiate between the plumbing that powers AI and the application that monetizes it. For investors, this shift matters because it changes where returns come from and where the risk begins to concentrate inside portfolios. The scale of spending still tells a powerful story. Some forecasts expect global AI investment to approach roughly $2 to $2.5 trillion by 2026, with infrastructure, servers, accelerators, networking, and storage remaining one of the fastest growing segments. Dedicated AI infrastructure alone could approach tens of billions in annual spending, compounding at strong double-digit rates into the next decade, and hardware still represents the majority of that investment today. In other words, the foundation is still being poured. The first phase has clearly been a picks and shovels trade. Data center revenue tied to AI has surged as hyperscalers and enterprises race to build what many now describe as AI factories. Large multi-million GPU projects pipelines suggest that we are still in an aggressive capital expenditure cycle, not yet a mature replacement phase. And here's an important note. Historically, heavy capex cycles tend to drive early leadership in infrastructure names before markets begin to ask different questions. What happens once the capacity is built? As more computing power comes online, the bottleneck shifts. It's no longer just about raw processing power. It is about efficiency, orchestration, and monetization. Software layers such as model orchestrations, MLOs, optimization, and observability are expected to grow faster than the hardware base itself because enterprises are starting to focus less on adding racks and more on extracting productivity from the computing power they already own. That transition is subtle, but it is very important. Even if global AI spending moves toward the multi-trillion-dollar range, infrastructure represents only one slice of the ecosystem. As deployment patterns stabilize, incremental capital is likely to shift toward domain-specific platforms, healthcare analytics, financial modeling, industrial automation, where pricing tied directly to business outcomes rather than new computer metrics. That's when AI starts to look less like a hardware cycle and more like a software ecosystem. So infrastructure isn't finished, but its risk-reward profile is evolving. GPU supply is improving, alternative chip ecosystems are emerging, and digestion phases in capex become more likely after periods of intense spending. That means broad exposure may give way to more selective positioning, focusing on companies with durable moats in system architecture, networking, cooling, and long-term sovereign or cloud build-outs rather than pure beta to hardware demand. The more durable compounding story may sit in software leverage. Platforms that compress deployment timelines, reduce interference cost, and embed AI into existing workflows have the potential to scale without same capital intensity as infrastructure providers. As organizations move from experimentation to production, budgets naturally tilt towards solutions that demonstrate measurable returns on invested cash, not just experimental projects, and that distinction becomes increasingly important as the cycle matures. So the first phase of the AI trade rewarded concentrated exposure to infrastructure leaders. Phase 2, however, may look different, a more balanced approach, maintaining core positions in high-quality infrastructure names while gradually increasing exposure to applications and platform softwares. Better reflects AI evolution from hardware supercycle into a broader ecosystem story, because the next leg of AI may not be about who builds the most strong chip or computer, but about who turns that computing power into productivity. This is FinTalk, where we look beyond the headlines and focus on how markets are actually evolving. I'm Tammy Beck, and see you next time.